Hello and welcome to Buy Africa, the show where we focus on investment opportunities around the continent. I'm Tsepo Mudiba, and thanks for joining me. Tonight, I'm joined by Roy Daniels, Head of Africa Trading at Rand Merchant Bank, and our focus is on specifically why there's been a drop in offshore investment into local currency bonds and how that's actually led to an increase in demand for Euro bonds. Roy, let's focus specifically on West Africa. I guess you can't start anywhere but Nigeria. Let's start briefly on your take on the current economic setting here. We know new presidency. What does that mean from an outlook perspective?
So I think given the new party in power, the new president in power, new governor, a lot of new stuff happening there, it's all a bit of wait and see now. So they've been calling for meetings with the treasurers and the CEOs of the banks to discuss various aspects in the market around liquidity, where's the demand coming from, why is there a drop in supply. So they're trying to get all those answers before they make any decisions, which I think that's very good. I think to make this sort of blurted announcement that got the whole market a little bit on edge, in times where markets are edgy, your communication has to be precise and clear.
Right.
So that led some of us to thinking, well, possibly they're going to reintroduce the interbank market. Are they going to move the peg? Are they going to devalue the currency? It's all that sort of what thinking. In the day, it was just a meeting to discuss aspects around the market and ready themselves for any policy changes they want to make in the future. We don't anticipate any big policy changes. We anticipate that they'd go back to interbank, but with a lot of support for the market. Now, have they got enough dollars to support the market? This is the big question.
Very big question indeed. You touch on an important point. I guess as investors, we don't like being surprised. We're almost agnostic as to what direction policy is. We just don't want to be surprised. In terms of, I guess, what that's meant for borrowing costs in Nigeria, what has that translated to?
So borrowing costs have picked up quite significantly because they've drained a lot of liquidity out of the market.
Yep.
They don't want the guys to have access to Naira to fund themselves if they're running short Naira positions. So drain as much liquidity out, make it expensive for guys to borrow on the short end of the curve. So, but that's normal practice. I think whenever we've seen currencies under pressure, you're going to drain a bit of liquidity, you're going to squeeze the market just a little bit more, you're going to keep it expensive for those who want to short it if you like, but we'll make it expensive. That said, they've kept a firm peg on the top end of the market. In fact, they've shifted their rate to the banks lower by 5 kobo for the last 2 weeks. Not this week, the previous 2 weeks. 5 kobo cheaper, 5 kobo cheaper. So the guys get demand for dollars from clients. They're going to go back it straight out with the central bank and say, listen, we need these dollars. Whether they get the full amount, we're not sure. I certainly know that from our RMB office in Lagos, we've gone looking for an X amount of dollars and got less than that amount and had to go back the next day for the balance. So they want to temper the demand. They want to keep things under as much control, the currency. I think if we look at the markets and say, is it good or is it bad? I know from an investment point of view, the stability is fantastic.
Right.
From a trading point of view, we'd like a little bit more volatility there somewhere, but we don't mind given the sort of wild volatility we've seen in Nigeria. I do think Nigerian market needs to continue calming down as it has before allowing it to go back to the interbank. And
will any of this translate into any difference on the underlying economic performance of Nigeria?
I think the weaker Naira, and we always think that they're big oil producers and they're crude producers and they're petrol importers. So where they're importing the petrol from. So sure, from the export point of view, it's working pretty well. But from the import point of view, the fuel point of view, they don't want that Naira that weak from this point on, from weaker than the 200 level. It's kind of a balanced number here. It works out okay for them. The important thing for them is the agricultural sector that they need to start driving a little bit harder. So that 200 naira to the dollar is going to work for the export side of the business. And they need to find that other export business and be not that reliant on fuel. So I think the current conditions, Nigeria and the Naira and the economy is sitting in a nice protective state. But it's a fragile bubble.
Right.
So for now, it looks okay.
For now. In terms of, I guess, funding, we know that there's quite a bit of infrastructure that needs to go into, or infrastructure development that needs to go into Nigeria. How are they likely to fund that? Is that raising more Nairas, or is that looking at foreign currency denominated debt?
I think given their low debt to GDP ratio and the very few Eurobonds that they have issued, I know the banking sector has issued Eurobond loans and they've gone for Euro financing, but that's the banking sector. That's one side of the problem, or one side of what they're doing, or of the economy. On the central bank side, they've got lots of scope to issue Eurobonds. I think that's a potential route for them. Again, you need to be careful around these Eurobonds. We can issue, and then we convert to local currency, and we're paying up a little bit more for them now than we were before. Currencies are weakening. So if you take a Eurobond of $1 billion and you convert that to your local currency and you start spending it on the various things, hopefully most of it's going into infrastructure. That's Africa's my concern for Africa.
Yep.
Hopefully most of that's going to infrastructure. And your currency devalues 20%.
Yep.
You're paying 20% more. Now, you're still going to pay $1 billion dollars back, but your value of your currency is depreciated. So that is kind of the concern, I think, that the guys need to look at. So from a Nigeria point of view, there's room to issue. There is infrastructure spend that's needed. I'll tell you, for one thing, I was there 2 weeks ago. I spent a week in Nigeria. The petrol queues are 2 cars wide, 2 kilometers long. You've got guys running up and down the road selling petrol out of jerry cans on the side. Yeah. Nigeria is it's a land of opportunity, you know, and chance whenever it comes along. But they've got one fuel depot in Lagos, 14 million people. So the infrastructure spend has to come on pipelines, transportation, fuel depots that have got pipelines into, and sort of feeder depots along the way. So there has to be a huge infrastructure spend in Nigeria. I traveled to Lagos and to Abuja, and the queues were the same in Abuja. In Abuja, fantastic roads. Now, Lagos needs to maybe work on the road network a little bit and solve some of those traffic problems. But lots of opportunity. But if your country is growing and you've got growth of 10%, you need to be spending 10% on infrastructure to keep pace with it. So, yeah, I think the Eurobond issuance is probably one of the easiest channels and the best channel for them to go to raise money.
And from, I guess, the bond investors' side, will there be a demand for those Nigerian issued Eurobonds?
There's always going to be a demand for Nigerian bonds. You know, if you've got an emerging market portfolio and you've got X percentage of that has to go into Africa, at this stage there's only 3 potential places that the people are looking at. One is Nigeria, one is South Africa, one is Kenya. Kenyan currency under a bit of pressure, so they kind of staying away from that, leaves you Nigeria and South Africa. Nigeria would get a lot more if we just had that final bits of stability added into that market. And that's just investor reinsurances, that when I need to cash out, I can cash out easily. It doesn't become a difficult process for me. The competition for them is South Africa. You sit here and they're going about South Africa's rand is weaker, but it's a usually liquid market.
Sure. So let's park Nigeria and move to Ghana. Your assessment of where they are currently.
Sure.
I guess that says it all.
Ghana, we held back on Ghana or looking for investment there, and you know our office is due to open 1 July. So we've invested from a banking position point of view. We've invested into Ghana. We've invested quite heavily into West Africa. We think there's huge growth. So we are going into Ghana. We don't think it's not a case of saying it's a basket case or you shouldn't be looking at it. It's all about a timing issue. So we've kind of held back on sort of taking any positions in Ghana because we've been waiting for the IMF talks. So the IMF talks came about and there was some half solutions, not a complete solution. There's no, like we said in the very beginning, clear communication and clear policy communicated to everybody, to investors, to those who want to trade the markets. So there's an ambiguity as to where are we actually now and what is the full package of the IMF assistance to them, so to Ghana. So we like the yields, but we're worried about the currency. So we're staying away from the currency side because we're trading in the local currency bond side of it. If you went into the Eurobond issuances, that removes then the FX risk for you. But those bonds, those Eurobonds have weakened slightly. The ones with the shorter maturities, funny enough, have actually increased in value. So their yields have dropped off a bit. But the longer end ones, now, can they issue more? So they can issue more Eurobonds, but how are they going to service these payments? Where are they going to get the revenue from? Oil hasn't hit the levels they wanted to hit, the crude. I mean, Ghana's producing 100,000, maybe 120,000 on a really good day, barrels per day, compared to their neighbors who are at 1.8 million barrels a day.
Yep.
Cocoa did okay. Gold, in fact, is another big exporter of theirs, but where's the gold price? So they're not earning as much. The problem for Ghana lies around the internal debt side of it and their sort of inability to balance their own fiscal books within the country due to the public sector wage bill.
Right, and I guess in a strange way, issuing more Eurobonds makes the situation a little bit more worse, given that if the currency or when the currency depreciates, their borrowing costs increase quite dramatically. Again,
you know, convert to the currency weakens, and now you've got this problem of now trying to repay from there. That said, they've weakened significantly. So is it now at a point where we say the currency's weakened far enough, the yields are looking good, now's the time to buy it? Please, please, Mr. Central Bank Governor, give us some sort of satisfaction or some guidance out of the policies that make us want to invest.
Sure. So would you say that Ghana is one where you're looking to wait and see rather than taking a definitive investment call right now?
Absolutely. Ghana is still a wait and see because of the lack of clear policy. Nigeria's a buy some, get out, buy some, get out.
Right.
So, and then the rest of Africa, again, it's a kind of a bit of a waiting game. I think when we look at the continent on a whole, it's kind of sitting there. We're not sure if it's going to go that way off the edge of a cliff or it's going to continue the growth pattern. It's kind of in a bit of a holding stage right now.
Sure. Perfect. Let's leave it there.
Thanks.
Thanks to my guest, Roy Daniels, Head of Africa Trading at Rand Merchant Bank. That's all from Buy Africa this week. Remember to follow me on Twitter, that's @Mudiba_Tsepo, and send us your thoughts about the show using the hashtag BuyAfrica. For myself and the team, goodbye.